Okay, let's go ahead and run through the solution to example 7.6, the downstream sale of a depreciable asset which is subsequently resold to a third party. And the parent is going to use the partial equity method. So just from the get-go, this is a downstream sale, so there won't be anything with the non-controlling interest to worry about. And since the parent is using the partial equity method, that means A, that there won't be any equity method entries related to this transaction, and B, when we carry forward the unrealized gain or loss, we'll be adjusting retained earnings. Okay, so let's assume that Big owns 80% of Little, and again, that is irrelevant because this is a downstream sale. On December 31st, 2001, Big sells equipment to Little for $80,000. The equipment was originally purchased on January 1st, 2000 for $90,000 with a 6-year expected life and no expected salvage value. The total expected useful life and salvage value were unchanged. In other words, there are 4 years left to go. And then a little bit later, on January 1st, 2004, Little subsequently resells the equipment to a third party for $45,000. Let's assume that Little reports earnings of $100,000 each year and pays no dividends, and Big uses the partial equity method. Okay, what do we need to do? As usual, we need to provide equity method entries related to Big's investment in Little for 2001 through 2004. We need to provide elimination entries related to this transaction for 2001 through 2004. That is, we're going to focus on the intercompany transaction elimination entries, ignoring all the other ones, the S, the A, the I, and so on. And third, we want to compute the income to the non-controlling shareholders for each year. Again, let's go ahead and get our background computations out in the open. The true depreciation expense is $90,000 original cost over the 6-year life, or $15,000 per year. When Big sells this to Little, Little is going to report depreciation expense of $20,000 per year. Again, they buy it for $80,000. It has 4 years left to go, so Little's reported depreciation is going to be $20,000 per year. Gain or loss on sale. Again, the original cost was $90,000. It's been depreciated for 2 years at $15,000 per year, so it has a book value of $60,000. It's being sold for $80,000, so there's a $20,000 gain on sale. And again, that gain is going to be recognized over the remaining 4 years at $5,000 per year. And to recognize that gain, we're going to reduce depreciation expense from the reported value of $20,000 down to the correct value of $15,000. Okay, let's go ahead and do our year of sale entries. First, the elimination entries. First, we have to get rid of the gain on sale. Again, this gain is on Big's income statement. It has to be removed because it is an unrealized gain. Next, we need to get the equipment back up to its true historical cost. It's on Little's balance sheet at $80,000. We've got to write it up to $90,000. And also, we need to reinstate Big's accumulated depreciation. Now, since this intercompany sale took place at the end of the year, Big, the seller, had already recorded the correct depreciation expense, so no adjustment is necessary this year. The income to the non-controlling shareholders, again, they're going to get their 20% of the adjusted / realized earnings of the subsidiary. This was a downstream sale, which means that this intercompany transaction does not affect the non-controlling shareholders. They will simply get their 20% of the subsidiary's reported earnings. Finally, the equity method entries, none, because again, this was a downstream transaction where the parent is using the partial equity method. That means they're not going to adjust their investment income to remove any unrealized gains or losses. For 2002, we'll go through the same drill. First, we carry forward the balances from the previous year. Again, we've got a $20,000 unrealized gain that's being carried forward. Since this is a downstream transaction, it doesn't affect the non-controlling shareholders. Since the parent is using the partial equity method, that unrealized gain being carried forward is treated as an adjustment to retained earnings. We carry forward that $10,000 debit to the equipment account, and we carry forward the $30,000 credit to accumulated depreciation. Once we do that, we go ahead and adjust 2002's depreciation expense. Again, we're recognizing that $20,000 gain over 4 years by reducing depreciation expense each year for 5 years. Basically, we're undoing $5,000 of Little's depreciation expense. The income to the non-controlling shareholders, again, this has no bearing on the non-controlling shareholders. They simply get their share of Little's reported earnings. And likewise with the equity method entries. Nothing going on as far as this intercompany transaction is concerned. In 2003, again, we carry forward our remaining unrealized gain or loss. We started with a $20,000 unrealized gain. We realized $5,000 of it in 2002, which means we're carrying forward $15,000 to 2003. We carry forward that $10,000 debit to the equipment account, and now we're carrying forward a $25,000 credit to accumulated depreciation. Just to recall, back in 2002, we credited accumulated depreciation for 30, and then we debited it for 5 when we adjusted depreciation expense. So we're carrying forward 25,000, and again we adjust our depreciation expense. The income to the non-controlling interest and the equity method entries, again, same as previously. Now in 2004, Little is going to go ahead and sell that equipment to a third party on January 1st, the very first day of 2004. Now at this point, December 31st, 2004, again we're doing our end of year elimination entries, the equipment is long gone. It's no longer on Little's balance sheet. Since it no longer exists on Little's balance sheet, we really don't want to put it back on the balance sheet via an elimination entry. Instead, we have to realize that there was still a $10,000 unrealized gain that we were carrying forward to 2004, and that gain has now been realized. So we're going to go ahead and recognize that $10,000 gain, which again has been deferred and was being carried forward. And for the last time, we have to adjust BIG's beginning of year retained earnings. Now, you can compare this to an earlier example where we subsequently resold land after an intercompany sale. It's the exact same principle. We've got this previously deferred gain, which is finally being recognized because the earnings process was completed via the sale of this asset to an external party.